Hello learner, welcome to Manifested e-learning platform. My name is FAM Lengwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017, and we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5% and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply to the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here, because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS, and that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there, and like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation amortization. In real life, trying to model depreciation amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here. The interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, How do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365, by 365 over here, 365, that. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue, just rearranging this formula. And that's exactly what we're going to do over here. We get the days are here, see where they are, just a second, accounts receivable days there, and then we multiply that with the revenue, then we divide over 365, and we have that value given to us there. So shift Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365, that. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. The accounts payable days, you can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold, and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that, because this is a formula here, it's just the total. So this one I'll put it in a different color, so that for consistency's sake, to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So shift, control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance, because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecasts. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement, and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable, you remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here, and you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that, and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net, the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that, then now I can drag it moving down like that, shift, control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is picked from the closing value here. This value has been picked from the closing value here. This one has been picked from the. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there to R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we're going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it with that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing because that's money going out, and then we add cash from financing so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you. Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, of all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, and you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. you are told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, complete to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here, so we open the brackets there, and then we multiply that with car assemblers corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here, Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So you pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that we can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1 beta of the market is always 1, because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of 2 brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following balance was extracted from the books of the society as at 31st of December 2021. We have a balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued rents, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 and $115,300 respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you're told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those 2 coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account, that is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These are accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad Marketing Account showing the profit and loss. Number 2, Mzuri Brad Marketing Account showing the profit or loss. And Part C, Statement of Profit or Loss for the year which ended 31st of December 2021. And finally, Statement of Financial Position. So as far as the first two accounts are required, Part A and Part B, whereby you're required to prepare the marketing account of the two coffee brands. We're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee brands. And what we are going to do, we are going to take now the sales, the sales of the two coffee brand, which is given in the additional information number 1. And then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1, and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%. Then we are going to less now the expenses, specifically relating to those two coffee brands. So we start with Part A. Part A of that particular question. We are required to prepare a Safi brand marketing account. Which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales. The sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was 175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate this into Kenyan shillings. I've said we're going to use now the exchange rate when the money was remitted out to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000. 175,000 then times 100. So that will give us 17.5 million. Take into account our figures are in thousand of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these two coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we list now the the expenses. So first of all, we have now to deduct amount due to members. Amount due to members. And basically in this case, we have said the amount due to members is 80%. Amount due to members. That amount due to members in our case we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17 500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17 500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item is the trial balance. We have the expenses associated with marketing and selling a SAFI. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860, and then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand. Marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings. And we're following the same format, We start with the sales, of this particular coffee brand, and that is given in the additional information number 1, which was 115,300, but this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11 or that is 11,530,000. So just like what you have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, you have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. An amount of 150. And then we have processing materials. An amount of 320. And then we have processing wages. Which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. These are some of the items which were marked as far as that part is concerned. And by doing that, you get now your 3 marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this is what the cooperative society was supposed to pay to the members. It had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative